Today we will take a closer look at what factoring actually means and what advantages and disadvantages it brings. Factoring refers to nothing more than the sale of receivables. Let's assume that Company A has sold goods to Company B on credit, resulting in a receivable from Company B. Company B therefore has a liability towards Company A. Company A is called the creditor in this case, while Company B is the debtor. Since Company A doesn't want to wait until the payment deadline is reached or even expects that the invoice will be delayed, Company A eventually sells the outstanding receivable from Company B to a third party, called the factor, which is usually a specialized factoring company or a bank. Company A hands over the receivable and, in return, receives a cash payment, which usually involves a certain discount on the receivable amount. Now, the factor has an outstanding receivable from Company B, while Company B's liability is now owed to the factor. Company A is thus off the hook and can fully focus on its core operations again. Now that we know what factoring is, let's take a look at its main advantages and disadvantages from a business perspective. Let's start with the advantages. A major advantage is that factoring strengthens liquidity. The company no longer has to wait long for the invoice to be settled, but receives the money much sooner. This improves the company's creditworthiness and allows it to reinvest the funds as quickly as possible. Moreover, factoring transfers the risk of non-payment. The company receives payment from the factoring company and no longer has to worry about the possibility of a default. The factoring company now bears the risk of non-payment. Finally, factoring allows the company to focus entirely on its core business without needing to allocate significant resources to accounts receivable management, which is another major benefit. All right, so much for the advantages. Unfortunately, factoring also comes with some disadvantages, which we'll look at next. Factoring typically involves a discount on the receivable amount, which is a significant disadvantage. The company cannot expect payment of the full outstanding amount, as the factoring company also needs to make a profit. Additionally, factoring can negatively impact the customer relationship. If the debtor company now has to make payments to a third party, namely the factoring company, and the original company is no longer the contact person, the debtor might feel blindsided. Finally, factoring comes with some contractual restrictions from the factoring company. Factoring is often only available as a comprehensive package, meaning that not just individual risky receivables, but the entire receivable portfolio over a certain period must be sold. Perfect! Now we know what factoring is and what advantages and disadvantages it brings. We hope this video has helped you understand the topic of factoring. See you next time and have a good one.